So this is a masterclass for CPA and financial advisors using smart mortgage strategies to help build long-term client wealth. So a little bit about myself, been doing this for 24 years. I am a mortgage planning specialist, top 1% year over year in several publications as far as production goes. And my expertise is jumbo investment property, what we call non-QM, construction loans, HELOCs, reverse mortgage, and wealth planning. So today's agenda is to go through the framework, application, and the practice. So why mortgage planning is wealth planning? Well, mortgage just isn't debt, it's a financial planning tool. Liquidity, as you know, shows how much a cash a client keeps accessible. Tax efficiency, how mortgage interest and structure interact with their broader tax picture, cash flow, investment opportunity, what the client's capital would look like otherwise, in risk management. So every one of these five factors touches your work directly. Why advisors should care. The mortgage is usually the client's largest liability, the client's largest single monthly payment, and housing decisions affect retirement timing and readiness, available investment capital, tax planning, estate planning, and overall cash flow. Why CPA should care. A write-off strategy interacts directly with mortgage qualification. Cash flow management affects both tax planning and financeability. Debt ratios matter for both lending and broader financial health, and liquidity decisions affects tax strategy and mortgage options alike. So working together creates better outcomes. The client works with a CPA for tax strategy and cash flow, a financial advisor, investment and retirement planning, mortgage planner for financing strategy and leverage, an attorney for estate, legal structure, trusts, realtor builder for property and construction execution. The best outcomes happen when these five perspectives really talk to each other. It's not an isolation. So mortgage planning timeline for the offer, loan strategy, then purchase, an annual review, refinance opportunities, retirement, legacy planning. Understanding the good debt, core concepts. Leverage is a tool for controlling larger assets. Inflation's effect on fixed rate debt over time, liquidity preserved, matching instead of paying cash, opportunity, cost of capital tied up in the property, and the importance of maintaining cash reserves. So productive debt and consumer debt are not the same conversation. Should clients put down 20%? It may make sense when liquidity and preserves remain strong afterward. No mortgage insurance. Client has no better use for that capital right now. But less down may make sense when the ROI from a expected investment returns exceed the mortgage rate. Liquidity is higher, near-term priority, and opportunity cost of the extra capital is significant. There's no universal right answer. Only the right answers for the client's financial picture. Opportunity cost, $100,000 invested versus applied as a down payment. We can see it reduces the payment, but what about growth? So we want to look at both pictures so we figure out what things actually look like and see what the best ROI for the client is. Cash flow planning, we want to look at total monthly obligations, emergency reserve targets, debt to income ratios, ongoing retirement contributions, and investment flexibility after the mortgage payment. And how could they continue to invest with the payment? So we go through analysis. This is our signature tool, and it works through 15, 20, 30% down, as it says here. And we like to go over, even with the CPA, often on Zoom calls, where we kind of unpack it all. And the accountant and CPA as well, and financial advisor. So we could go through overall analysis, cash flow, and what makes the most sense to continue that legacy planning. There are other strategies like home equity lines of credit, which maintains liquidity without selling investments. Using a line of credit against a property may be an emergency fund alternative. It can fund business needs for owner-operator clients, financing renovations, capturing investment opportunities without disrupting a portfolio. Home equity loans, fixed predictable payments are a priority, funding a specific capital improvement. And it's really for those clients who prefer certainty over flexibility. Cash out refinancing, it's a hard one right now. To lie. But rates higher? Yeah, I mean, for sure. It's not 2020. So the current rate is at or above today's market rate. We look at a blended rate from the second mortgage to see what's going to make the most amount of sense. If the client needs a large single infusion of capital, it may make sense. But when it doesn't make sense, client holds favorable rate below market rate, of course, as I mentioned, and the amount needed doesn't justify resetting the entire loan. There are non-QM solutions available, especially for self-employed individuals, bank statement loans, 1099 income program, asset utilization, profit and loss loans, or DSCR loans, which uses the income of the property to qualify. This benefits business owners, retirees, and real estate investors looking to scale a portfolio. Business owners, what makes their scenario different? Cash flow that doesn't map cleanly to W-2 or 1040. Write-offs that reduce taxable income, also reduce qualifying income for a mortgage. Income planning decisions that directly affect mortgage eligibility, liquidity needs for both business and personal life, and expansion plans that compete with personal borrowing capacity. So, high net worth buyers. Well, common income complexities that we see is restricted stock investing schedules, bonus heavy compensation, trust income, large investment reserves can be used for qualification, and there's multiple layered income sources. Keep in mind with investors, what matters most to them is qualifying, getting cash flow, developing the portfolio that nets their yield on monthly rents, as well as looking at appreciation through the property itself. So leverage strategy across multiple properties, clear exit strategies for each asset. We tend to go over that with that in great detail with them. Construction renovation planning, where this fits the plan is simple. Okay, construction financing for ground up builds, ADU financing for supplemental income if they're looking for an ADU, or perhaps having a family member move, a child move back with them, or older family member move in with them. Renovation financing for value add strategy, investment property improvements to increase returns. Reverse mortgage planning. So legitimate planning uses supplementing retirement cash flow, managing sequence of returns risk, supporting longevity planning, and coordinating with legacy and estate goals. It's a real planning tool for the right client, not a last resort. Aging in place planning. This is where mortgage strategy intersects with looking at housing modifications for accessibility, multi-generation family planning, coordinating financing with broader financial planning goals. Estate planning considerations, always worth discussing with attorney, trust ownership of property, inherited property, family property transfers, and gift-related strategies. Tax planning considerations, always worth that CPA conversation. This is where I usually refer the CPAs that I work with, and of course you as well. So let's schedule that call. But mortgage interest deductibility, capital improvements and basis, investment property tax treatment. Insurance planning, always worth looking at coverage, umbrella coverage, flood coverage where it's applicable, in coordination with life insurance planning. So one thing I do, I think it sets us apart, is an annual mortgage review, one of the most underused tools in client retention. We review the client's current rate against today's market, reassessing available equity, confirming insurance coverage is still adequate, and revisiting the client's goals since the last review. An annual mortgage review is a natural low pressure touch point that keeps you at the table. In fact, when we do these, I love it when the CPA and financial advisor join us. Common mistakes are things to avoid, of course. Avoid these. Recommend too much down payment without liquidity conversation. Leaving a client with too little liquidity. Choosing the wrong loan structure for the client's actual goals, ignoring tax implications for a financing decision, skipping the annual review, and waiting too long to revisit outdated mortgage strategy. So we do have several case studies here. We had a young physician that actually just took a job with Kaiser in San Rafael, California. High income, limited liquid reserves, just out of the residency. We used a physician-focused loan program. It was pretty easy with the student loan debt, and quite honestly, it was able to work with the offer letter that was available through Kaiser, preserve capital for the practice investment that they later want to do as well. We had a business owner, super heavy write-off income. So we used a bank statement to help them purchase a property while still holding on to their departing residence, and we coordinated this closely with their CPA. We had a retired couple that our reverse mortgage team really helped out with. We were looking at reverse mortgage, but then we figured, hey, we could use an asset utilization program. We preserve their investment portfolio structure, maintain the property, and simply use asset utilization to help them qualify. So some questions we often get is, should wealthy clients always pay cash? Not necessarily. It depends on liquidity needs and opportunity costs, not just the ability to pay cash. When should clients refinance? Generally, with the new rate and terms generally improve their position, not at every single rate dip. When should clients leverage? When the after cost debt is reasonably lower than expected return of return capital. Should business owners use bank statements? Often, yes, when tax return income doesn't reflect their true cash flow. So why advisors partner with us? What we bring, mortgage coach analysis for every scenario. Genuine planning conversation, not just transactions, fast, responsive approvals, and clear communication throughout. A client-first philosophy that protects a relationship that you've built. Building referral partnerships, how we support you. Coordinated planning for shared clients, timely, proactive communication, respect for your role as a primary advisor relationship, and collaborative, not competitive approach. We also have co-branded education opportunities, lunch and learn seminars that we can certainly do with you, either on Zoom or in your office. And our mortgage planning process is simple: discovery, financial review, loan strategy, that mortgage coach analysis, execution, and an annual review. We have resources. If you want any of these, shoot me a message, schedule a call with me. I'd be happy to get them over to you. Your next steps are schedule a strategy meeting. Let's look at opportunities together, and let's coordinate with your client's full advisory team. If you have any questions, of course, my information is below. Love to connect with you. There's my information as well. You can call, text, email anytime. Thank you for spending some time with us, watching this. Looking forward to connecting with you.